K through O covered the essentials, from KYC and liquidity to mutual funds, your net worth, and options. But picking the right assets is only half the battle. If you leave those assets exposed, taxes and fees can erode your returns before you ever see a cent of profit. Today, we're looking at the specific accounts and tax strategies that determine your actual take-home wealth. To build wealth that lasts, you have to operate in two distinct phases: assembling an investment engine and then surrounding it with a tax-efficient chassis. The engine itself starts with P, your portfolio. This is the collection of everything you own: stocks, bonds, cash, and real estate, all held together. Think of it like a plate at a buffet. One item isn't a meal. The intentional mix of everything is what actually provides sustenance. Because a portfolio can grow quite large, we organize it by S, sectors. A sector groups similar companies into distinct industries, like tech, energy, or healthcare. If the stock market is a mall, each sector is a different store category. During a recession, consumer retail might see sales drop, while discount stores or essential utilities might surge. Holding multiple sectors helps manage that volatility. A diversified portfolio of sectors creates growth, but it remains vulnerable if it sits in an account where every gain is taxed immediately. That brings us to the chassis, the specialized legal accounts used to protect your portfolio from tax erosion. The first is R, the RRSP. Contributions here reduce your taxable income now, allowing your investments to grow with taxes deferred until you withdraw the money later. Essentially, you take a tax break now in a high bracket and pay it back in retirement when your rate is lower. Then there is T, the TFSA. You contribute after-tax money. In exchange, every dollar of growth and withdrawal is completely tax-free. You've already paid for the ingredients. The meal that comes out of the container is yours to keep, regardless of how much it grew. The difference in long-term wealth often comes down to placing the right sector and the right tax account. When your engine and your tax chassis work together over time, your capital begins to reach a new scale. Eventually, that growth pushes your net worth or income past specific regulatory thresholds. This is Q, the qualified investor. This status provides legal access to private funds that are not open to the general public. It's the exact same financial market as everyone else, but you finally met the requirements to move past the velvet rope. Becoming a qualified investor changes the rules of the game, allowing you to participate in institutional-grade investments that were previously out of reach. This sequence forms a functional blueprint for building wealth. You build the engine, you shield it, and you scale it. You select your sectors to construct a unified portfolio and place them inside an RRSP or a TFSA until your assets reach the level of a qualified investor. The foundation is set. Stick around for U through Z, where we'll cover yield, volatility, and how to put this blueprint into action.